Hey team, it's Matt from Universal CPA Review. Thanks for checking out this video where we'll walk through an example simulation on valuation techniques. So we're going to be given a wide variety of information, including an analyst report, some financial statements, and then we're going to have to calculate a handful of ratios and then ultimately determine, do we think the company is overvalued or undervalued relative to its peers, right? So it's going to be a great representation of what you might actually see on the exam. Now, real quick, please subscribe to our YouTube channel. We love to get more subscribers. If you're studying for the exam and you need some support, join our Facebook groups. The link is in the description of this video, as well as the free 14-day trial link. If you haven't tried out the Universal platform, try it out. And then lastly, please reach out to us about any promotions and the Spilt milk program, right? Catchy name. I'm sure you want to find out what it's all about. So let's dive into the video. So this simulation on valuation techniques, this is a complex topic that we are going to try and simplify. Now in this question, we are going to be looking at Toodle, which is a dog care company. Now ultimately, we need to figure out some of the ratios, calculate them, figure out their valuation, and then learn how to interpret it, right? So we're given the financial statements for Toodle for year 6 and year 7. Those were pulled from sec.gov. And then Anavra, who's an analyst at Blum Capital, she went ahead and prepared a great analyst report that we'll use for our analysis. So without further ado, let's dive into calculating the ratios. There's going to be a handful of ratios we have to calculate first, and then the last two questions will focus on interpreting those ratios and determining, is Toodle overvalued or undervalued relative to its peers, right? That is how we're going to use some of these valuation ratios. So the first ratio that we need to calculate is the price to sales ratio, and it says to base it on the historical 12-month results. So looking at the formula, it's not that difficult, right? We're just taking the market price and dividing by sales. And this is going to be for year 7, right? Everything in this report is focused on year 7. So when we look at the market price, right, we can either talk about the total market cap, we can talk about the market price per share. It really doesn't matter as long as the denominator is also in the same format. So I'm actually going to go to the analyst report that was prepared by Anavra, and it says that the market cap is $58 million, right? So fairly big company. Now, when it comes to sales, we can either look at the income statement or we can look at the analyst report that has the same information. Basically, sales is $5,335,000 for year 7. So when we divide 58 million by 5,335,000 of sales, that gets us to a price to sales ratio of 10.87. Now let's move on to the price to book ratio. And again, this is for the historical 12 months for year 7. So when we look at this ratio, it's not that much different, right? On the numerator side, we have the same thing, the market price, which will still be that 58 million. And then on the denominator side, we have book value. Now this is based on the book value of the company's, equity, right? It's net assets. And that is going to be equity straight from the balance sheet for year 7. So when we look at the balance sheet, well, for year 7, equity was $460,000. Now, if we didn't have equity and we only had assets and liabilities, we would just take assets minus liabilities, and that still gets us to the $460,000, right? That's going to be the net assets. So divide the market price of 58 million by book value of 460,000, and that gets us a price to book ratio of 126.09, right? Remember, round to 2 decimal points. Now moving on, we're going to do the price to cash flow ratio. And again, this one, not radically different. Numerator side, we still have that market price, but we need to get cash flows for the denominator. And the one thing I must stress over and over again is that net income is not the same as cash flows, right? There are going to be some adjustments we're going to have to make. So let's start by calculating the company's cash flow for year 7. So I always like to start with net income, right? Think back to FAR when we did the indirect cash flow method. And if you haven't taken FAR, well, this is a great example of how to calculate cash flow when we're given net income as our starting point. So based on the income statement for year 7, net income was $905,000. Now, in general, we also have to think about what are some non-cash expenses that are burdening net income, right? Reducing our total net income. Well, the most obvious non-cash expense is depreciation and amortization, right? We're reducing net income by $160,000, but let's think about it. When we actually record depreciation or amortization, are we actually paying out any cash? The answer is no to that, right? So when going to cash flow, we are going to add back that amount. So that is why it's a positive $160,000. Now, the next thing we have to factor in is the change in current assets and the change in current liabilities. So starting with current assets, when we look at the balance sheet and we exclude cash, well, we actually see a $5,000 increase in current assets, again, excluding cash. And when current assets increase, yeah, that's great. We have more current assets, but it results in a cash outflow more or less, right? So that increase in current assets is a negative $5,000. Now on the current liabilities side, if current liabilities did increase, well, that would be a cash inflow. But guess what? It went from $180,000 down to $150,000. So we actually had more cash going out the door than we did of accruing new expenses, right? So that is why it's a negative $30,000 adjustment for our cash flow calculation. And then the last thing we need to think about is, did the company have capital expenditures? And real quick, right, when we purchase equipment, well, we capitalize that onto the balance sheet and then we depreciate it, right? There's no actual cash impact for that amount in our net income, right? It's only flowing through depreciation. Now we added back depreciation, but we still had that cash outflow if we had capital expenditures. And when we look at the analyst report, it does say that in year 7, we had capital expenditures of $5,000. So guess what? We will have to reduce our cash flow by $5,000. So we have everything factored in here. When we take all the additions and the subtractions, we end up with cash flow of $1,125,000. Well, now that we have the market price, which is still $58 million, and now we have cash flows of $1,025,000, just divide by that cash flow amount, and we get a price to cash flow ratio of 56.59. So the next two rows are based on the price to earnings ratio. Now, we can look at this on a trailing or tailing 12 months or forward looking. We're actually going to do both here, right? So let's start with the historical 12 months. If we go to the analyst report, it says the earnings per share was 31 cents per share, right? The 0.31. Now that's on a per share basis, and for the market price, we've been using total market cap. So we're actually going to have to convert that market price to a per share amount. But it's not that hard, right? We're just going to take the 58 million, divide by shares outstanding of 2,900,000, and that gets us to a price of $20 per share. So now we just need to take that $20 price per share, divide by the EPS for year 7 of 31 cents per share, and that gets us to a PE ratio of 64.52. Now for the price to earnings ratio based on the forward-looking 12 months, very similar, except where can we get the forecasted or forward-looking amount for the next year or 4 quarters? Well, if we go to the analyst report, they put together some forward-looking information. And based on some of their analysis and listening to some of the management team during earnings calls, well, the forward-looking EPS for year 8 is actually going to be 35 cents per share, right? So similar to what we just did for the other PE ratio, we're just going to take that market price of $20, divide by the forward earnings per share of 35 cents per share, and that gets us a PE ratio of 57.14. So we've gone through and calculated all of the ratios that we need to calculate. So that is sort of part one in my book. Now, part two is learning how to interpret these ratios, right? Somebody's calculating these for some specific reason, and it's going to be to determine whether the company is overvalued or undervalued. Now, it's tough to look at these ratios without comparing them either to the historical ratios for that company or peers in their industry. Well, the next two rows focus on comparing the PE ratio for Tootle to the PE ratio for its peers. And if we look at the analyst report, at the very bottom it says the industry information, and it talks about the PE ratio for the historical 12-month. Well, the median there is 69.2, and if we look forward 12 months, the median PE ratio is 55.4. So what we can do is compare those median PE ratios for the industry to the ratios we just calculated for Tootle. So starting with the historical PE ratio, right? We calculated that and it was 64.52 for Tootle. Now, if the median PE ratio is 69.2, right, that is higher, which means that in general, Tootle, their market price, as compared to the earnings per share, it's a lower amount, right? So in a sense, we could say Tootle is undervalued, or it's not as expensive compared to its peers, right? So for that, it's going to be undervalued. Now on the flip side, if we look at the forward PE ratio, which is looking at the next 12 months of earnings per share, well, we calculated that forward PE ratio as 57.14 for Tootle. However, the analyst report indicates that the median PE ratio on a forward-looking basis is 55.4. So in this case, Tootle is actually greater or higher than the median, which says that basically they're going to be more expensive relative to their peers, so they are going to be overvalued, right? So that is how we can use these ratios, specifically the PE ratio in this case, to compare the ratio for a specific company to the median or average in the peer group, right? And to then determine, are they overvalued or undervalued? So that was a great example of how we could take just information that we're given, pull out what we need to calculate these ratios, and then learn how to interpret it, right? We could have been asked to use any other ratio in this simulation to determine whether the company is undervalued or overvalued. So go back and think about how you would have thought through if that were the case, right? So great simulation, great topic. I always love to teach this stuff. So let me know if you have any questions.